Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Hi, everyone. Welcome to episode 43 of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, first off, you and I are sitting right next to each other in the home office in Omaha, so it's a little weird being next to each other. Usually
Doesn't
we do
happen
this
often.
Yeah, usually we do this remotely, but we are really excited and honored to be joined by Meb Faber, a close friend of the show, partner with Carson Group, ETFs we leverage. Sonu, you're obviously I'm excited. Sonu's even more excited, Meb, I think. How excited are you, Sonu? Sitting down?
It's an honor. Yeah, it's an honor to have Meb on. Been following Meb's work for ages, so thank you for being on the show. And like Ryan, you mentioned, we've used Meb's work in our own models, and so with great success over the years. So
it's great. It's great to be here, guys. I was laughing as you said ETFs we leverage, because that word can mean a lot of different things to a lot of different people. So hopefully you're like 4x margin on these guys. You're buying even more.
That's.
I don't know what we're allowed to say compliance wise, but no.
I didn't mean that. I didn't mean leverage compliance. I didn't mean that. Yeah, I'm not like that. But yeah, Meb, so you said it's a little early for you in California, but you took some time with us. I mean, what if you weren't doing this with us, what would you be doing right now?
Falling off a surfboard. Yep. I'm a Colorado native, so I'm being out here in California at the beach. I love the beach, but certainly have adapted. But I'm much better on two skis than I am on one surfboard. But we have a new office in Manhattan Beach, so you guys come visit. Nice. We'll take you out for a walk on the beach, a surf. We can go chat markets over coffee or beers or tacos or whatever have you. Listeners, that applies to you too. Come see us. We got a new great spot.
Neat. Now, how close is that to PIMCO's offices? I have no clue, and this might be way off. Are you close to those?
This is a non-Angelino California and asking. So by the crow flies or by the drive, it could be anywhere between maybe an hour or 4, depending on what's
we might be out. We might be out in PIMCO's office in October, so maybe
on the 405.
Yeah. Okay.
Well, Fashion Island it's like Fashion Island is like its own galaxy of you can just walk around and everyone in the investing world is hanging out. Although Bill, I think, is out in Palm Springs playing golf now, but the rest of the crew is there.
Interesting. Yeah. How long have you been out in California?
Long enough to say I'm from here, but I still not ready for it. I moved out after my favorite bubble, the internet bubble. Graduated university in 2000 in many, the gold rush, but over a century later, moved out to the land of milk and honey, San Francisco. And unfortunately, I timed it poorly versus, my friends who were a few years older who graduated in the late 90s. It was just champagne was flowing like water. We've had a bit of a repeat. I never thought I'd see anything like that again in my career. But here we were with the COVID kind of craziness in 2020. And did a brief stint up in Lake Tahoe as well. And then moved to Los Angeles, which I assumed I would hate in the kind of early mid 2000s, like 2005. And, 1 year turned into 15 and here we are.
It's you mentioned California. So actually it's a good segue because California has a pension retirement system. So I wanted to ask you that, I think this is a few years ago, maybe they had an open position for a CIO. And I think did you put your hat in the ring for that, or?
I love to publicly poke my finger in CalPERS eye, but this applies to a lot of the institutions too. We've done a number of investing posts one was called "Should CalPERS be managed by a robot?" And we did the same thing with talk about Harvard and Bridgewater with their all-weather, and a lot of these big money institutions have hundreds of investors and they pay out zillions of dollars of fees, and they have these super complicated investing portfolios. And the problem, with a lot of them is they have not just one constituent. Like if you're a financial advisor, an investment manager, and you're a planner to one family or one individual, like you have one client. But Harvard or CalPERS has students and alumni and future students and faculty and employees and on and on and on and on. 20 different conflicts of interest, not conflicts, but interested parties. How do you treat current generations, but future generations, on and on and on. Anyway, our whole point on the CalPERS side was they would probably be better off firing their entire staff, replacing all these really complicated funds and private funds that pay 2 and 20 with a bunch of ETFs. And we've modeled out and shown that actually they would do just fine, if not better, doing that. And I'm a very generous portfolio manager. So I said, I would be happy to run your portfolio. I'll tell you what, I'll do it for free. I said, at the annual meeting, you can buy me a 6-pack of pale ale. I think I used to say IPAs, but I can't drink. They're too bitter for me now. I'm convinced they give me really terrible next day hangover. So even if I drink just one or two. So now I'm back to pale ales or a hoppy pilsner. So it's pale ales. And I'll rebalance once a year. And that's that. I did actually literally apply.
You did? Okay.
Given our history, I think they've
didn't go so well.
But I took that as a mild offense. So we've had a long time endowment style, family office style ETF filed that should make it to market here in the next year or so. I joke that I'm going to rent a giant billboard right outside their office and say, all right, guys, the time is here. Can you beat me? Like, here's our ticker symbol ETF, and just have a little fun with it. But no, I mean, I think it's a joking topic, but I think it's actually pretty, you can get into the seriousness of why we believe this to be true. But, it speaks to so much in our world: complexity versus simplicity, the really high fees versus low fees, coming up with a process. I mean, they just announced the other day, they've been investing in venture capital. Their returns for the last 20 years in the golden age of venture capital have essentially been zero.
Wow.
But they're like, what we're going to do? We're going to not double down, sextuple down on our venture capital investment. We're so bad at this, we're going to go 6 times bigger than we used to be. Lord have mercy. Bless their little hearts. My Southern family would say, I wish them the best of luck, but it's needlessly complex for my mind.
Wow.
And all we do is leverage your ETFs. No, I was not kidding.
There you go, CalPERS. If you're listening, 2x Cambria ETFs, and you're
so
done.
Meb, if you weren't awake, now we got your blood boiling talking about CalPERS. We did that to wake you up. Let's kind of wheel this back for a second. By the way, you said the word California. I've been watching the Arnold Schwarzenegger 3-episode series on Netflix. He goes California. I love the way he says California. Anyway, I hear that. That was a great series. But let's start kind of from the beginning. Let's reel this back in. First off, what's your title? I think sometimes our compliance wants to title. Meb Faber, all around great guy. What is your title right now?
Founder, CEO, but as you guys know, I mean, these small entrepreneurial organizations do everything. We're currently been modeling out our office, so picking out couches, taking out the trash, putting up signs, all that good stuff. So part-time architect apparently, but kind of all of it above. What do I spend most of my time really doing? I love doing the research and writing and chatting with friends like you guys.
And so obviously we have over 350 partners here at Carson. This podcast is publicly out there. A lot of advisors listen to it. So maybe just, a couple of minutes, kind of what do you do that helps advisors out there?
Yeah, I think this will resonate with a lot of advisors. As you mentioned about what's your role, one of the challenges that people in our world is like everyone gets seduced by the investing, the fun part, the sexy part. How much do clients actually really care about how the sausage gets made? Sometimes is flipped on what we want to be spending our time on. But the business of money management is a lot different than managing money. And so, we're a traditional asset manager in one sense, in that we have public funds. We have 12 of them. We're very non-traditional, non-consensus in kind of how we've been built, but also the style and strategy of the funds. We say to people, It's the best time ever to be an investor. There's over 10,000 funds out there. You can buy the global market cap weight portfolio for essentially zero today. Unbelievable. And tax efficient ETFs. Best time ever. But the buffet and the menu is limitless. And so we say, well, what is a company like ours who just hit a 10-year track record in May on our oldest fund? How do we have the gall to believe that we should be launching? Who needs any more funds, right? There's plenty out there. Well, we say we only launch funds that either don't exist or we think we can do much better, quote, or much cheaper. And cheaper is rare these days. You know, you have Vanguard and State Street and Schwab and everybody fighting out at 0%. But in some cases, it's true. I mean, I think all 12 of our funds are cheaper than the category average, and a couple are the cheapest fund in the category. Now, caveat, that's usually because Vanguard's not there, or at least not yet. But we try to exist in this little dark corner where our thesis is, if the global market cap portfolio is free and you're going to charge more than zero, which we do, you better be doing something kind of weird, concentrated, and different. And we say that as a compliment, not as something like, oh, you got to, avoid that, but really something that if you're going to pay more than zero, it needs to be something that moves the needle. And so, we're right around 2 billion, have over 140,000 investors. And so, our approach, it doesn't mean it has to be crazy or weird or esoteric. It'd be really, our largest fund is 100 stocks long only, the most basic thing you can come up with. But it does mean that you want to get the exposure you're paying for. The nerdy language would be like active share, right? So we are probably going to launch, half a dozen, 10, maybe more funds. We keep coming up with ideas where we look around and say, why are people launching the 500th AI fund? There's so many other weird ideas that means they may not be good ideas, but ideas that we think deserve a place on the buffet too.
Can you tease us? What are some of the weird ideas? Maybe one you're not even doing. What are some of the weird ideas? Because like you said, my impression is there's so many funds are all out there.
Yeah.
What are some you're
so
looking
many
at
AI
or
ones, as you mentioned.
considering?
You told me I'm not allowed to go wonky and deep on this podcast, and then you immediately ask a wonky and deep question. So
I'll wheel you in if it goes off the rails.
We've written a lot of. We have a Twitter thread called "What is something I believe that 75% of my professional peers would disagree with," and that's like 20 deep already. And some of the white papers, which listeners you can download for free on either Cambria Funds, mebfaber.com, all of our books usually. And we put out some that are quite a bit different. So already the buffet of the 12 we have is quite different. Now, an example would be we wrote a paper. This, of the dozen or so white papers written, this is probably the one that's been downloaded the least. But we wrote a paper that theoretically, from the standpoint of somebody who's wealthy in California, New York, or really anywhere in the US, and you're a high taxable investor, the last thing you want is more income to pay taxes on, right? And to get your exposure. So we wrote a paper looking at dividend and income investing and value stocks and a better way to go about tax optimization, where the end result of this paper was you actually would want to be investing in zero yielding security stocks in the US, which nobody wants, right? Like this is the worst marketing idea of all time. Somebody says, you got a zero yielding fund or a low yielding fund. Nobody wants that. So, but the math works out to where that after tax, which no one really thinks about, they think about it once per year and then they go away, is actually a better investing approach. That's a good example of something walking. Now, there's no funds to my knowledge that do that. And there's very actually little in the academic literature that looks at it like this. There's only like one other paper we saw that talked about it. So you asked for it, but there you go.
That's actually interesting, considering we're in Omaha, as a very famous investor here who loves companies who pay dividends. And it's Warren Buffett, obviously, for our listeners, but he doesn't pay any dividends out. And
he has once. He claimed he was in the bathroom when the board decided to pay a dividend. I think it was back in like the 70s or 60s or something. But yeah, he says he's never paid one, but he loves them, loves to get them.
Right. So it's just digging into that. I know, like, we can go a little bit wonky here, but dividends is one way companies return cash to shareholders, right? Now, I've read one of my favorite books is Global Shareholder Yield, the one you wrote, probably a decade ago, was it? But I highly recommend that for anyone listening. But with that, in that book, you talk about how companies, another way for them to, couple of ways to return money cash to shareholders is by buybacks and via, paying down debt as well, right? Maybe you talk a little bit about that, because buybacks, and I think, whether it's the Wall Street Journal, New York Times, buybacks have gotten such a bad rap,
Yes,
right?
they have.
And so maybe you can talk a little bit about, buybacks versus dividends and the whole tax thing that you just brought up.
Yeah, if you could go back in time and talk to the person who came up with the phrase buybacks and say, no, let's come up with a different phrase. Let's call them tax efficient dividends or flexible dividends. The world would be different, right? This would be a different multiverse, because people's brains just short circuit when you talk about buybacks for some unknown reason. I don't know why. It's such a strange phrase. It's such a boring concept, really, for politicians and everyone else to get up in arms about. But there's a lot of misinformation. People love saying buybacks used to be illegal. That's not true. They've existed as long as markets have been existed. And in fact, about a century ago, if you look at the kind of ways corporations interacted with governments and investors, many investors used to require the companies to pay out dividends or buy back their stock because they would assume the CEOs would squander it, right? These megalomaniacs, what are they going to do? They're going to go name stadiums. They're going to go buy jets. They're going to pay themselves a lot more money. But what we talked about the shareholder yield, which is, again, was a book, and it's the basis for our kind of flagship fund, which is our largest fund, SYLD, and then we have FYLD and EYLD, which is the foreign and emerging, and there's going to be some more coming. But this concept, which is really goes back not only to just Buffett, but to Ben Graham, of what do you want when you invest in a company? You want a company that generates a ton of cash flow, treats its shareholders fairly or with respect, does it with not leveraging up with a ton of debt, and it's a high quality business. Like, that sounds like a great 101 level to me. The key is that there was a structural change to where companies started buying back more stock versus paying out dividends. And dividends and buybacks are the exact same if a company's trading at intrinsic value. Buffett talks about this. If the stock is trading below intrinsic value, he says there's no better use of cash than to buy back stock if it's trading far below intrinsic value. And Buffett, we joked on Twitter when the pandemic was happening, we said it's going to drive the Buffett fanboys crazy when he doesn't elephant hunt and buy a bunch of companies during the pandemic, but he just buys back Berkshire stock, because he said publicly he's going to buy it back if it gets down to about 1.3 or 1.2. And so that's what he did. He bought back a bunch of stock. So, but if you look historically speaking at really starting in the late 90s, buybacks have outpaced dividends in every year since then. So if you're a dividend or income investor or an equity investor that ignores buybacks, you're missing over half of what a company does with its cash, which is crazy to me, because there's over 600 dividend and income funds in the US. And the vast majority, if not all of them, ignore buybacks. Now, here's why that's even more important. Yes, it's interesting on the buyback component. It's also equally as important to avoid the companies that are serial issuers. And most of the companies in the US are issuing stock. And why is that important? If you look at the last cycle in particular, the tech companies, they did massive amounts of share-based executive compensation. So just making it rain with options on all of the executives, the C-suite, it was like 20% of tech company revenue in the last couple of years was just stock-based compensation, which a lot of them try to quote, not expense. It's not a real expense. So incorporating both sides of that ledger, looking holistically at what we call shareholder yield, so dividends plus net buybacks. Apple's a great example. We held the stock for almost a decade in our fund. It did both. So it's never going to show up on a dividend screen. It's never going to show up on a buyback screen. And the media loves to talk about all the terrible examples of companies that bought back stock. You never hear them talk about Apple, where on their way from below $1 trillion company to a $3 trillion company, they're buying back stock the whole way, right? So the historical modeling demonstrates that shareholder yield is a much better approach than any of the dividend approaches you can come up with, in my mind, that I've seen. Now, the cool part is, since we've launched it, the shareholder yield, we now have 10-year track record, which we can kind of demonstrate. It's one thing to come up with a back test. I love coming up with back tests. You can come up with anything that you want to show the world, but it's really where the rubber meets the road, where the actual trading, and we think it's been indicative of what shareholder yield can do in the U.S. and abroad as well. We think it's very thoughtful. Now, we think it's There's slight differences in the way that companies do it in the U.S. versus abroad, but equally, if not more important, abroad than it is in the U.S.
And full disclosure, we use SYLD and FYLD in our models. We've used it for a few years now. So that, but I like the term, like instead of buybacks, using tax efficient dividends. Maybe we should use that going forward.
Damodaran, the NYU professor, talks a lot about this, and he gets it. And so we have advisors, if you're listening, we have a blog post called FAQ on buybacks for journalists, gurus, investors, on, and we add to it. It's got about 20 resources that are really phenomenal: podcasts, white papers, fact sheets about the misconceptions and all that goes into corporate governance and how to think about the role of a CEO and how they treat their shareholders with stock and all this sort of compensation. The interesting part is we're at a period in history right now where a lot of the big quants talk about this opportunity and value, right? Where there's this massive spread between the cheap stuff and the expensive stuff in the US. And it's one of the biggest spreads ever. So top decile, we would say, in the industry. Also true in foreign and emerging as well. So shareholder yield, and if you look at the funds, listeners, you can just go throw them into Morningstar or any of these publicly available websites. They'll give you a snapshot of what the funds own. And you can see in real time that these funds have a huge spread in valuation compared to the overall market, as well as a lot of the really expensive stuff. Now, 2020 was actually the worst year ever for value investing. And since then, we believe the regime has shifted. You've had great returns in value since then. Horrific decade before that. With the exception, you have a little wiggle now. We'll see how kind of 2023 plays out in the future. But we think this is one of the best times ever to be allocating to value for the next 3, 5, 10 years.
That's interesting. So we mentioned advisors, and a lot of them listen to this. I will say also, Meb, what we found, by the way, we've had like 3 people listen from Australia. Did you know that?
I didn't know that.
Yeah, we've got hello to our friends in Australia that listen to this. But we also have younger people. I've had so many younger people that reach out and listen to this podcast. Let's go back to, 99, 98, 2000, younger Meb, back in his college days. This is one of those standard questions, but I love to ask it. What's some advice you'd give someone who's looking to get into the financial industry, into managing money, into, talking models, kind of stuff we've done here? What would you tell your younger self to share some, maybe to avoid some pain for somebody else?
Oh boy, you asked a few different questions in there. So
yeah, I did. I kept going as a runoff. I didn't ask you about the Denver Broncos yet. We'll get to the Denver Broncos. So, I know that's what you really want to talk about. Yeah.
We can talk about the Nuggets. How about let's stay optimistic?
Ooh,
let's stay
that's true. That's a good point. Yeah, congrats.
So there's a few parts. So one, be happy you're a time billionaire. And we were talking to. I was giving a speech once in Ireland at Trinity College, and I was talking to some students and was talking about compounding and say, look, a lot of you are getting ready to go on, I think it was a graduation trip, their version of spring break. And I said, look, you can go down to Ibiza, spend $2,000 and it'd be amazing. I was like, or you can put this in a global stock market. And, in 50 years from now, that $2,000 is probably going to be worth around $200,000. Like, that's the crazy part of the time billionaire concept, where you're young, the compounding, the math just gets out of control, wonderful in your favor. Now, I said, however, here's the hard part, is that it might be a better idea for you to go to Ibiza. You might, have a lifetime of memories. You might meet your future partner. It may be worth it, but realize that like every investment and transaction is a trade-off, where empathy with your future self. One day you're going to wake up like me, and I'm 46, and say, man, I wish I hadn't spent that, money at that point and invested it instead. Anyway, so realize you have a long track record, and so many young people want to, do everything today, this week, the whole Robinhood crowd. I got so frustrated publicly in tweeting about it. I say, Robinhood is so dangerous because they bring all the investors to the casino under the smokescreen of saying, we're onboard you to markets. We're going to get you invested. We're getting people to invest that otherwise wouldn't invest. I said, yes, but you're teaching them all the wrong lessons, right? It's like, hey, we're going to take you, but here, by the way, we're going to teach you how to play craps and blackjack, which you're guaranteed to lose. And so One is on the investing side is commit to a lifetime of learning. Again, there's been no better time. For the last like 5 years, we've curated what we consider to be the top podcasts of the week. And so that's an idea. That's a Spotify playlist. There's a free service we do have called the Idea Farm. We send out one email a week, and listeners, if you're young, there's over, I don't know, 1,000 archives at this point. So you can download the top institutional level research and pieces that have been put out over the past decade. Download them all, read them all, and that's like a MBA, CFA level 3 in investing if you went through all those over the years. So that's a free resource. It's a great time. We have another post called like the Learn to Invest that has the 5, what we consider to be the crowdsourced 5 best investing books on learning how to invest. We did a little poll, and we think it's a wonderful research. My favorite book is Triumph of the Optimists. That's a little like 201, 301 level. It's not necessarily the 101 intro book, but we think it's a fantastic resource. As far as getting a job, I think the best piece of advice is to be of value. You know, the mistake I made in my 20s, and I see every single applicant make, is they make the proposal about themselves. They email you, they call you, spend no time doing research, and say, hey, look, you know, my name's Sonu. I'm looking for a job, and here's all about me. 2 paragraphs. Here's what I'm looking to do. You know, here's my resume. And you're like, that's exact opposite of what you should be doing. It's 180, literally like the exact opposite. What you should be saying is like, you know, hey, look, I've researched your company. I know this and that about you. By the way, there's a misspelling on your website on page 3. I'm willing to come in and work as hard as possible and do anything that you guys, you know, can make you. And here's my suggestions on maybe a couple of things that I could do or help you out. There's one of the Cubs, Theo Epstein, GM used to be, gosh, it's been a while, but he had a great piece of advice where he's like, even if you're in a current role, he's like, go up to your boss and basically like, what, you don't have to say it this way, but basically, what is the 20% of your job that you hate doing, and let me do it. Like, let me take over. You're going to make yourself a wonderful friend because you're taking over the garbage they don't want to do, but also you're learning their job, right? You're learning what's going on at the next level. And so many people, again, it's not about you, it's about them. And so learning to become indispensable and become a value, I think is a big part. So we're hiring, listeners. So see if you can use this advice and transform it into a career at Cambria. We'll listen.
I love the stuff about being, you know, ready to learn, willing to learn, and keeping that, you know, desire to learn going over, you know, lifetime, really, more than anything else. All those books behind you, I was curious, like if you had to pick 3 books, you mentioned Triumph of the Optimist, but maybe, you know, you pull out a couple of, you don't have to pull it out, but, you know, mention a couple of others that you really like.
Yeah.
In terms of investing.
I could go show you how my Murphy bed transforms. I was very upset when my wife announced we were purchasing this. Now it's like my favorite piece of our house. So, you know, I'll just give you the preview. We did this post called Learn to Invest because I was a little frustrated because to me, in my mind, there's not like a single book that a high school age, even a later in life, but 101 level investing book that I would definitively hand out to people for investing. I mean, there's a handful on personal finance, but on investing. And I'll tell you the crowd pick winners. And there's a full survey list. So there's like 50 books if you want to get them together, listeners. It's called Learning How to Invest. And if you just search my name, Meb Faber, it'll come up. But the 5 winners were, for personal finance, The Millionaire Next Door by Stanley. We actually just had his daughter on the podcast recently. Stocks, The Little Book of Common Sense Investing by Bogle, RIP Jack, but one of the great titans of our industry. Asset Allocation. They picked my book, Global Asset Allocation, but because that's a bit biased, we said the non-Meb version was The Intelligent Asset Allocator by Bernstein. History Markets, They Like Fooled by Randomness by Taleb. And for Investing 2.0, What Works on Wall Street, that's like, you know, kind of a master's level, but really good quant book. Behavioral, Thinking Fast and Slow, which I've actually never read, Kahneman. And lastly, Manager Profiles. And this is one of the books that, you know, certainly got me going in the industry, the original Market Wizards books. by
Love
Chuck
those.
Schwager. And I loved all those. I also loved all the Jim Rogers books, Investment Biker, Adventure Capitalist, traveling all over the world to Ecuador and Japan and Russia and investing all over the world. I think gives you a perspective that most myopic U.S. investors don't really have.
And speaking of myopic U.S. investors, one big thing you always say is you don't want to be concentrated in the U.S., right? In terms of asset allocation. I mean, I think most of us, I should say, I'll include us, tend to be biased towards our home countries, and we being in the U.S. tend to be, biased towards the U.S. and it's done well over the last decade, right? That there is a bet has sort of paid off. How do you think about that in terms of like asset allocation, and especially if you're thinking about, okay, I want to allocate some part of my money to stocks. How should we think about U.S. versus ex-U.S., outside the U.S.?
This is a strange hill for me to die on, because our largest fund, by an order of magnitude, I believe, is a U.S. stock fund. So let me check my business bias at the door, listeners. It's not like we're a foreign-only shop. Like, no, our largest fund is U.S. stock fund. I think it's important to try to be intellectually honest. And for me, the long history of capital markets, my favorite example for investors that look at U.S. stocks, and there's like 3 or 4 things they always say to justify their home bias. And the first is always, well, U.S. stocks have beaten everything else over the past century. They're like, not just this decade, Meb, it's this past century. I say, well, that's actually not true. Australia's been better. South Africa's been better. Do you invest all your money there? And also, that's a very backwards looking metric. Like, what has done best is not going to be what will do best.
Meb, I just want to jump in. Australia's done better because we've got 3 listeners in that country to this podcast.
Yeah, exactly. Well, look, you guys want to do a trip down to Melbourne or Sydney? I'll join you.
I love that.
And so scratch that one off. Second is, by the way, it doesn't always do best. If you look at the long history of capital markets, we have a post on the blog called "The Case for Global Investing," and it curates research of about 5 research pieces, and one of them was Bridgewater, where it looked at equal weight or GDP weight. The U.S. is only a quarter of world GDP, by the way. Mm-hmm. But if you look at just weighting globally equity markets, in every case across all these equity markets, the big fat drawdown when you were concentrated in your own country, it would have been better to diversify and be equal weighted or GDP weighted, right? Like it made more sense to diversify. But every country around the world does this. So it's not just the US. So our Japanese friends, Indian friends, Australian friends, they all put most of their money in their own market because it feels warm and cozy. Broncos, Nuggets fan, I'm never going to cheer for the Browns. So it feels safe. People say, I feel like I know the companies here, which is total BS. But if you look at the long history of just the US versus that equal weight, the US creamed everything in the 2010s, whatever you call that decade. But the opposite was true in the decade prior, right? Mm-hmm. After the internet bubble, US was beaten by everything.
Right.
Small cap value beat US market cap by 150 percentage points from 2000 to 2003. US 90s, of course, beat everything else. But before that, you had to go back to 1910, 70 years where the US was one of the premier markets, but decade by decade, you would have been better off in equal weight or diversified weight. There's about 10 other reasons why it's crazy. But if you look at just the last year or two, I mean, look what happened in Russia. Having this single country exposure to me is just totally bananas. And so you go around the world today, if you travel and you talk to our friends in UK, Greece, China, Brazil, on and on. You say, what was putting all your money in your own stock market a great idea? They say, no, that's crazy. It's terrible. We should have bought the US, right? Or whatever it may be. So it's, to me, is you want to diversify your bets. The world is your oyster. And I mean, the best part I say to people, look, let's say you love the US. You really want to invest in US stocks. How about we put 10 times as much in the US as we put in any other country? People say, okay, I like that idea. Not even 5 times, not double, 10 times as much. Okay, guess what you got? You got the global market cap weight, which is 60% US, 40% foreign. So we agree. And they're like, no, wait, hold on. That's way too much in foreign. We said, well, you just said you want to put 10 times as much. that's what it looks like. Now, it's problematic, particularly today, because the U.S. is one of the most expensive countries in the world. It's not awful. I think it's not bubble territory, but it is more of a comment that the rest of the world looks better. And I think, again, within the U.S., you can be totally fine by hanging out in the value and quality names. But I think the rest of the world is much better. But the way market cap weighting works is you put most of your money in the things that have gone up. So in 99, you put most of your money in U.S. stocks. In 89, you put most of your money in Japanese stocks when they were the most expensive they've ever been. And that's a flaw of market cap weighting. It's not a fatal flaw, but it is a Achilles heel that we think you could index in a better way that is anything but market cap weighting.
Well, Meb, this was a great discussion. We've kind of hit the end here very quickly. Congrats again to your Nuggets. They're probably going to win it for about 3-4 more years in a row. So we'll just give that to them. What about your Broncos? Real quick.
Good. I was at Game 5. You know, I made a very classic quant mistake, and we should do this for 2 hours next time, guys. It's way too short.
Okay. Yeah.
I went to Game 2 with my brother, and as a quant, I said, you know what? I understand that the prices come down all the way to game time. So if we can just have the emotional fortitude, this is the time arbitrage, like public markets, we can get tickets for much cheaper than they were over the past few weeks. And this is a classic, this is a behavioral bias. And sure enough, we buy tickets. We're hanging out at the pub, ready to go to the game. But the app was over flooded and basically crashed. And so we ended up watching Game 2 from the pub. Now, the good news is we saved all the money because the Nuggets lost in Game 2.
Yeah.
And they gave us a big fat credit for the next game. So then we ended up going to Game 5. So we watched for the finale. However, I had to leave directly after the game because I had to make it back on the last flight out of Denver to Los Angeles for kindergarten graduation, which is a thing today, which I made, by the way, but only after a 7-hour flight delay. So if you saw me in the Denver airport that night, listeners, I am sorry. I apologize for my appearance, but I made it home and was at the game. So it was all worth it.
That's exciting. Let's end on this note. You've mentioned a few things. Tell us very quickly about your podcast, maybe your website, Twitter, just reiterate some of the ways that the listeners can follow all the cool stuff you're doing.
Yeah, we gotta reverse the mic and have you guys come jabber on the show. We like to meet investors where they are, and so we originally started writing white papers over a decade ago, and then books and blogs, and more modern world, it's Twitter and who knows what's coming next, threads and holograms, I don't know. But we got a lot of people say we'll never read one of your white papers, but we'll listen to an audio show or a podcast and or a webinar. So we try to meet investors where they are and want to consume information. But my day job is Cambria Investments, which is either Cambria Funds, Cambria Investments. The blog is mebfaber.com. You can watch me pick fights on Twitter. And also our free research service is called theideafarm.com.
Awesome.
That's fantastic.
Well, Meb, thank you so much. This was a great discussion. Wanted to use the word leverage again, but I'm just not going to use the word leverage again. Leveraging your brain, I guess. We appreciate it. Episode 43 of Carson's Facts versus Feelings is in the books. Thanks again, Meb. We'll see everybody next week. Should be a lot of fun. Take care. Goodbye.
Thanks, guys. Let's do it again sometime.
Thank you.